I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward at what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market had another volatile week as moves of 1% and 2% in the major indexes have become routine. The week started off looking okay as Apple got upgraded on Monday and it nudged a valuation of $3 trillion. But the stock reversed sharply and selling came in on Monday as Bojo out of the UK said Omicron, well, there's a tidal wave of that coming, and had the first death from that virus. Retail, travel, hospitality, air all got slammed, and it really didn't recover all week long. Then more selling came on Tuesday as the PPI came out up 0.8% versus an estimate of 0.5%. That's year over year up 9.8%, a record. The core was up 0.7%, and that's 7.7% year over year. Tech stocks and investors nervous about the increase in interest rates based on that, well, they sold them hard. Solar also led on the downside as California came out and they said they're cutting their incentives on rooftop solar. It didn't help that China had come out earlier that day and said that their economy was slowing sharply. And this week was a big week for the central banks as our Fed, the Bank of England, Bank of Japan, Swiss National Bank, European Central Bank, all of them had meetings. And they have a lot to deal with, the fact that they have completely blown it. Wednesday, well, the market was soft into the Fed policy and that presser. The Russell was very weak, and that had a breakdown of key levels on Wednesday. Fed did as expected. They doubled the rate of the taper, and they expect to be done in March. Their dot plots changed pretty hawkishly, where now they're looking for 22 to have 3 rate increases and 23 to have 4 rate increases, and that is a big change. Powell said the labor market, well, it's tight. 4.2% on the U3, and he said that actually could be full employment. Of course, he's probably right because that 3.5% we had was in a time of massive stimulation, and that, of course, is changing. And he said in some ways it's the employment market is tighter than in the last cycle. Stocks took off that day, however, as the news came out. The S&P 500 had a 2-hour 100-point range. It seemed like they thought, well, that the Fed is taking a dovish pace. That's what some analysts said. Nomura came out and said that big investors were overhedged, as they had expected that the Fed would do what they did and the market would get hit, and they had to scramble. So that was short covering, and you saw that play out as Thursday, the market changed very significantly. Thursday, there were sellers in techs, and they came back aggressively. And that 370-point rally that we saw in the Nasdaq on Wednesday, well, it disappeared and reversed as techs got absolutely slammed. Adobe came out with weak guidance, and Apple and Xilinx and NVIDIA and Qualcomm all went down following Adobe's 11% decline. The PMI came out weaker, but input costs were very high. Wages, transportation, energy costs, and that's all bad for margins. And hence the weak guidance that we're getting out of a lot of stocks. And the sellers were back for sure on Thursday. And clearly the Fed is off rhythm. They're tightening now when the economy is going to slow. What do they think they're doing? We had a lot of news that came out from the central banks. Actually, the Swiss National Bank, ECB, Bank of Japan, all of them really slow walking to the inevitable increases that are coming. But the Bank of England, as we had noted a few times, they were the first one to actually raise their rates. They wanted to do that before Omicron had slowed them down, but now they have done that. And of course, our Fed, they actually may end up to be more aggressive if these numbers don't improve on inflation. On Friday, stocks very weak again, led by the techs. And these stocks that had lowered guidance on poor earnings or other factors that are saying based on input costs or based on the supply chain problems that they're not going to do as well. Good examples of that were Darden and Rivian. Rivian, a EV stock that is a brand new company, and they're already saying there's problems. And overall, fear of these changing central bank policies is putting a ton of pressure on the market. As they say, the worm has turned. And we're in a period now of very high volatility. As we said, 1% and 2% moves every day seem to be becoming routine. JP Morgan came out and they said that they expect much weaker holiday spending. And that's probably true, as the people that got a lot of money out of the government during the pandemic now have spent that. And savings rate was very high, but that, of course, has changed. So the stock market has been in a period of huge disparity. A few high-tech stocks held up the indexes, and many other sectors crumbled. And now the techs are under pressure. So what are the chances of 22 having the same facade of those techs kind of holding up the indexes while the rest of the market doesn't do that well? Well, I've got something to show you right now that I think might help clear that up. This is a fascinating chart that I'm going to put up here. And the thing is, question, what happens to the top dogs? Market Watch put out this article from research affiliates and their head, Robert Arnott, that I think is absolutely fascinating. What this is a picture of the S&P compared to a rebalancing. It's the top 10 world top 10 markets portfolio leaders. And this right over here shows you how they have done compared to the S&P. And the red line over here is the top 10 portfolio market, as if it were rebalanced. I know that's a little bit confusing, but if you take the top 10 stocks in the portfolio, and then what you do is rebalance them based on the fact that they've done better, this is what your result will be. It's about half the performance, cut in half. So what clearly that says, and I know this feels like it's a little bit confusing, is that the stocks that lead the market every single year, they tend to get much weaker moving forward. And in this case, the stocks that have led these last couple of years in our stock market have been these high-tech, mega-cap stocks. If you assume that the same thing is going to happen, where the best stocks become the ones that lag, then what's going to happen here is that the indexes here in the United States are going to lag. This is proof going back all the way back to 1980. So we're looking at 41 years of making this comparison. Again, if you rebalance the 10 largest companies, the ones that have done the best at the highest market caps, and you then give them the balance in the portfolio that they have grown to, then what happens is that you get a very poor performance in that new portfolio, because the ones that were the best becomes the ones that are the worst. And in this case, what that's saying is that our indexes here are going to have a lot of problems because they've been very, very heavily weighted by just these few stocks. And now you can expect, as you see now going on in Microsoft and Apple, as these stocks get exceptionally weak, that is actually what's going on. What that looks like to us is that, well, there will be places to invest in 22. And a lot of the beaten up stocks might give opportunities when the market gets slammed. But that's not going to be the indexes. They're not going to be the best places to be. And I say right now, just wait, build cash, and wait for those opportunities when some of the new strength, the stocks that show the new strength, show up in 22. And those are the places that we want to be. Right now, really clear to me, it's not going to be the indexes that are the place to be in 22. For the week, the major stock indexes, well, they're down between 1.5% and 3%. Nasdaq clearly the worst. The bond market, 30 years up 1 1/8 points. The 10 years down about 10 basis points. So this is a strong bond market, weak yields, weak interest rates, on the week that the Fed got the most hawkish in your face. Gold up about $22, and it's in a resistance area, but there is room up to about $18.40. So we see the possibility, especially since we think the dollar is going to get softer here. There's a pretty good possibility that we'll get an uptick in the gold and silver market. Silver up about 28 cents on the week, very volatile week, and we can see silver getting up to between 23 and 23.45, and these really still in the ranges, and we don't expect that to change until mid-22. Dollar, well, that tested 97. We expected that. It got just a few ticks below it, and then started to back off a little bit more. It might have another test of it, but 0.3 gain on the week for the dollar, 0.3%. And we think that the short term is about to roll over in the dollar, and that will help the metals for a brief period of time get an uptick. Oil for the week up about 70%. There is a room for it to rebound a bit more. We're looking for potentially $73 to $73.80 and then turn down again. If you want to see all of our deep analysis on 26 different futures contracts, weekly and daily, with our cycle analysis and proprietary indicators, please do watch FutureSpeak every Wednesday. That's for members level 2, 3, and 4. Coming up, we have a preview on a great video put out by RV, 12 stocks to watch. There's 6 positive and 6 negative stocks. And this, again, is a member video for levels 2, 3, and 4. And we're going to show you a preview of that, showing you one of the positive stocks and one of the negative stocks. And I'm going to give you a really good look at the S&P 500 and Nasdaq on a view for the next 1 to 3 months. That's what's coming up in this show. Please do go to askSlim.com, look around there. If you're new, you could just become a free member. That would kind of put you in touch with us. On YouTube, please do subscribe to this channel. Click the notification bell, and you'll know when we put up videos. And like this video, give it a thumbs up. On Twitter, follow at askSlim. Questions on our memberships, info, anything that we show you today. We have an amazingly broad amount of information that we put out every single week for our 4 analysts. So write to Matt at askSlim.com. Make sure that you take a look at our annual holiday specials when you go to the askSlim site. Great gifts for traders and investors. Give that gift of askSlim. We have special rates of non-recurring memberships. So you sign up, you're not going to get charged again for whoever you give the gift to, or you can give it to yourself. And it's great for first-time people that are looking for great information. You get a good idea of what we do on a 3-month membership. And if you're a member right now, you can use it to upgrade and look at our higher memberships. And if you do that, we're going to give you a bonus gift. We will send you an Amazon gift card to help you pay for that. As you, I know you want to spend a lot of money on other gifts for other people for the season, and we're going to help you do that with this bonus gift card that we're going to send you back for subscribing. Please go to the top of the front page at askSlim.com, right over here, that little green box way up on the top there. Click that, and you will see all of these great offers that we have at askSlim.com. This is the special annual holiday special, and you will only be able to get this now for about the next week and a half. So don't miss this opportunity. Now is the time to do it. Give that gift of askSlim. All right, we're going to look at a preview here of a great video done by Arvi. one of our great analysts here, and certainly our lead cycle analyst. He does fantastic work. If you're not familiar with the work, make sure that you do watch this video right now. 12 stocks to watch, 6 negative and 6 positive, and essentially you're going to get a lesson on cycle analysis, which he does in every single video that he produces. This is a great one. Take a look at this, 12 stocks to watch in our stock sectors category.
So this is CMCSA, and this is a really clear chart with just one single key money flow pattern in play. You can see the rising phases and corrective phases very clearly, with key lows here that have formed very close to the idealized timing. Now, what I want to highlight is this nice base off of the COVID low, such as what we saw in many names. And after that, we got a confirmation of that base as we moved into this rising phase and broke out through that old swing high here in that next rising phase. After that, we formed a positive cycle with a higher cycle low relative to the prior low and a higher cycle high relative to the prior cycle high. When that happens, the odds would favor a new swing high in that next rising phase, and that is what happened. After that, you'll see we had a sell-off that actually broke this key weekly low, and we now have a bearish weekly cycle configuration. When you have that, what you're looking for is only for a rally into this red zone. Where is that red zone drawn from? It's drawn from this recent swing high to this recent swing low. We use our fib tool to come up with our resistance zones, and those come in from 52 to around 56 or so. So that's really what we're looking for in Comcast. Really looking for a move more to the middle of this range, or around 54, and that's with Comcast trading right now at 49.21. So still a decent percentage move on the upside in a name that is not really super volatile here. What I do want to note is that we do have negative weekly momentum, so we do want to see that curl back to the upside and turn positive, such as what happened here and here and here, and all of that did confirm that we were in that next rising phase here on the weeklies. That's really what we're watching for here in Comcast. Overall, a bearish overall pattern, but likely to get into a time window where we can get a decent percentage move on the upside in this next rising phase here. Next one, let's look at CRM. So this is Salesforce. Obviously, it's been a monster stock for many years. If I just zoom out on this chart, as we all know, and you can see we're in this rising phase, had the rally, and then have actually violated this key weekly low. And this is really saying that an early high has formed. You can see this strong downturn in the weekly momentum right here as well. So looking for any little rally here to then set up movements back on the downside. On the downside, we have a major 61.8 at 243 and a major 78.6 at 225. Our next key low is due 314 to 425, and our levels on the upside are 273.80 to 288.42. That's really the zone that we would look for CRM to fail in on any rally. And if we just bring over the fib tool, we have a 78.6 at 298. So we absolutely need to stay below that level to keep this overall bearish bias intact. But really, based on this overall shape with an early high that's formed, we would look for very muted rallies and then swift failures. That's really what this looks like to us here in CRM.
Great work, Harvey. I want to invite all of you to watch that whole video. If you're not a member level 2 or 3, 4, you could now subscribe and take advantage of our great Christmas special to watch that whole video. 6 positive, 6 negative stocks with very significant patterns that are offering some pretty good trades moving forward. That is our good look at our stock sectors preview for today. All right, we're going to look at the stock market, S&P 500, Nasdaq, and the VIX. This analysis, of course, is a combination of our some of the evidence that comes out of looking at cycle analysis, momentum analysis, and our swing high, swing low analysis. That's the type of analysis we do. One more reminder in here, please do go to askSlim.com for our holiday special, Give the Gift of askSlim. Go to the front page, up on the top, click the little green box that says 30% off, and you can get all of the details on the askSlim Holiday Special non-recurring 3-month memberships. Give the gift to somebody that you know loves trading or investing, or give it to yourself, and we'll send you a bonus gift of an Amazon gift card to help you pay for other people's gifts. Here is the look at the stock market. And we're going to start out by looking at the S&P 500. The charts we're going to look at are weekly charts and have our cycle analysis on it. So the different arcs that you see on the bottom right over here, those are what's called a cycle bracket for those of you that are new. And what we're looking at is a dominant cycle length now that's shifted at about 26 weeks. And then there's this minor one in here that runs 9 to 11 weeks that you can see that's been fairly consistent. You can see the low right here, and the low right here, and the low here, and then right here. So it's 1, 2, 3, 4 of those, and then this rally. Now, the stock market right now is amazingly still holding up when you look at the S&P 500. I'll show you the Nasdaq. It's weaker. The Russell I'm not going to show you, but that has broken down already. So that really is looking like it is the first warning when we see the formation in the Russell. So again, some of the evidence is what we look at. The first part of that is cycle analysis. And the cycle analysis in here shows, well, this is the first week of this next minor cycle that you see in the bottom. And then what we're having is a pullback here, but it's pulled back to support. Let me just take a little tighter look right in here. And you can see that it has gotten to that little support zone right over there, gave up about half of that, and then has rebounded. Of course, we're in a period of favorable seasonality right now. You wouldn't know it looking at the way that the market is acting. However, that seasonality will probably keep the market from moving down in any significant way over the next week. Now, there's a short-term pattern that says there are issues, and I'll talk a little bit more about that in a moment. Let's take a little closer look right in here and look at this gray box, and you can see that what we're talking about here for the conditions of the market are that the S&P 500 intermediate gets a slight downgrade. The momentum has now turned negative. This is the reversal scout. You can see when the reversal scout turns down, it gives you a warning that momentum is down. When the reversal scout turns up, it gives you a warning that momentum is turning up and that the previous low right over here is actually a cycle low. And then the swing high, swing low analysis gives us this support right over here and projections. Projections still remain getting up here and testing the high. It actually, the futures equaled or got over the high a little bit, but then reversed overnight. So they didn't quite make it. The cash didn't quite make it. The futures made it overnight, but that's not what our charts reflect. Still, this is looking at the potential for the S&P 500 to get up to about 4780, 4785 over the next several weeks. And then we get into another period where these cycles are coming down, and there's risk right over here. So the conditions in here are negative when you look at that downturn right over there, which is significant. Cycle patterns remain positive, and the phase is rising. For the short term, momentum is starting to fail, but it is still positive and failing. Now, when I show you the Nasdaq, it's worse. Cycle patterns are, we'll call them neutral right now when we look at the short term and the intermediate term. Our option bias indicator, a very important indicator, is neutral, and our market condition indicator is still positive, but it keeps dancing between positive and neutral, but kind of holding up there. The next phase, and right now that phase is rising for the short term. The next trough is January 4th to 12th. That means that it's pretty likely that there's going to be a decline sometime and maybe just before the end of the year and into that time frame. And that would be a period that there would be another period of risk. So you can see when you look at the S&P 500 here, it is still in this uptrend that's been going on. The momentum is just barely turning over. And even though we've had a ton of selling, it's not that bad yet. You could still get higher prices in here before the peak set, and we thought the peak would be in the first quarter. It is showing some signs that at best it will be as a test or slightly getting better. Now, when we look at the Nasdaq in here, that is a very different story right here. And let's get a little closer look here. And the Nasdaq, you could see momentum turns down right over here. It got down to the support, but what's happening is that, let me just blow this up a little bit more. What's happening is that the shorter term patterns are giving you more indications of problems. So when I look at the conditions here on the Nasdaq, actually that says S&P, but this is the Nasdaq right now. The intermediate term is now downgraded in here because momentum has clearly turned negative. The cycle pattern now is neutral. And the phase is in a peaking phase. You see this sell signal right over there, and then you get it over here with momentum. So we rate the phase as peaking, and you can see in here we're showing the trend right in here as coming down. Now, the short term is downgraded. Momentum is negative. Cycle patterns are neutral to negative. Our OBI, option bias indicator, is neutral, and our market condition indicator is only slightly positive now. So that is all giving ground. The phase is declining in the short term, and the next trough, January 4th to 12th. So what that tells us is that things are deteriorating pretty significantly here on the Nasdaq, and this peak right over here looks to be very significant, and we're very likely to see some attempted rally in here, but then turning down, and this period out over here into March really looks like quite a difficult period for the Nasdaq. I'm going to go back to the S&P 500 now again, so you could see that that same period over there into March is very significant as you get this turn down over here, and this period, this yellow oval gives you this period of risk that takes you out into March. So what it really looks like to me is that you could hold up in here. You could try to take out the highs, but it's not going to make it by much. And that ultimately what's going to happen is that you get some very wide swings that end up making the top in here with a fairly good decline out into March. That is the 1 to 3 month view. We'll just call it choppy right now, a deteriorating condition going on, certainly in the mega caps, and certainly seeing that in the Nasdaq, and breakdown in the Russell, and the likelihood that we're going to see choppy market and a peak that comes in the early part of the first quarter, if we haven't seen it already, and then a market that is much weaker into March. The declines into March were projecting for the S&P 500 down to that 50% fib, and getting below 44.95 suggests a major top. And that would be a possibility. I mean, we were just down close to that not that long ago. 44.95, the key number to look at. That will declare a top in this bull market and some trouble out there in 22. That is what we expect anyway. And that is a look at the stock market. We certainly would be raising cash as the market tries to do better here in this holiday season. That's a look at the stock market. I want to remind you, please go to askSlim.com and look around. If you're new, become a free member. Subscribe to our YouTube channel, give us a thumbs up, and watch the member videos in the playlist, and you'll get some good idea of some of our past shows and some of the things that we share to members. Follow us on Twitter at askSlim, and for questions on our specials that we're running now for the holiday season, anything on our huge offerings of education and analysis, you can write to Matt at askSlim. That's going to wrap us up for this week. I want you to be extremely careful because it is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm going to do a steady show. And I know all my fans want to learn how to make some dough. I've been